Recently, the Office of the Superintendent has raised the stress test in an effort to cool down the hot Canadian real estate market that we're having right now. Now, was this a wise decision? How is it going to impact you and the demand for real estate? And what's the new proposed stress test? Well, in this video, I'm going to be discussing all of that and much more, so stay tuned and let's get into today's video. What is up everybody, just Dhillon here. Before diving into today's stress test and what are the implications of this new rule, let's get into what the media and the media outlets had to say about this. Now, to bring calm to this madness, let's first define what a stress test is, as when I was getting into real estate, had no idea, and what has changed as of June 1st, 2021. A stress test in finance can be defined as a risk management technique utilized by many financial institutions. So as you guys can see from the screen, a mortgage stress test is a way to determine how much can you afford and under what circumstances. A mortgage stress test requires the banks or other financial institutions such as credit unions to check that a borrower can still make their mortgage payments at a rate that's higher than what they actually paid for. So aside from all the definitions, now let's take a look at an actual example of how the new stress test will affect the whole home buying process. Let's say right now that you get a mortgage interest rate for 1.78% from the best Canadian bank out there. However, the Bank of Canada's or the BOC's qualifying rate right now, it's 5.25% as of June 1st, 2021. So even though you qualified for that lower rate at 1.78%, the bank will run two different calculations. One for that 1.78% that you got qualified for, and the second one at the 5.25%, which is the Bank of Canada's qualifying rate as of June 1st, 2021. So, according to the mortgage calculations that I ran on the mortgage calculator, a Toronto buyer with an annual income of $100,000, a 20% down payment, and a 5-year mortgage rate at 1.78% would have qualified for a home valued at $651,000 under a 5.25% qualifying rate as per the Bank of Canada. Therefore, what does this mean? Well, if you're in the market to buy a house, this directly means that due to the increased qualifying rate, your purchasing power is decreased, and it directly reduces the amount of mortgage that a particular household can qualify by 5%. So, in simpler terms, if before the new stress test you were able to qualify for a $1 million mortgage, now you can only qualify for a $950,000 mortgage. And to give you guys some context, before this rule actually was applied, there were some talks that this rule will only be applied, so this new stress test would only be applied to uninsured mortgages, meaning people who are putting down at least 20% or more for their homes. However, the stricter Canadian mortgage rules now will apply to everyone, even first-time home buyers. So, if you've recently been pre-approved, I would urge you to go and contact your mortgage broker to re-examine what mortgage amount are you pre-approved for now. So, the next question that comes in mind is, was this actually a wise decision to make? Well, before answering that question, let's get into what Ben Gully, who is the assistant superintendent, had to say to City News in a public statement. So he mentioned, in a complicated and sometimes volatile housing market, the need for sound mortgage underwriting cannot be underestimated. The rate is in place as of June 1st, 2021, which is the 5.25% which I just mentioned, will help support the financial resilience should economic circumstances change, while our commitment to review the qualifying rate at least annually will contribute to continued confidence in the Canadian financial system. So, from that statement, we can deduct that the reasoning behind doing this was to create a more resilient economy and prevent mortgage defaults in the near future. Now, the question lies, will this change prove effective in lowering demand for real estate and stabilizing the Canadian real estate market? Well, before I answer that question and to give you guys some perspective, heading into April, as per the Canadian Real Estate Association, home sales were up 250% on a year-by-year comparison. And the stress test was increased from 4.79% the previous year to 5.25% as of June 1st, 2021. So keeping this change in mind, I personally do not think that the increase in the qualifying rate to 5.25% will prove as effective as the superintendent would like in controlling the demand for real estate and stabilizing the hot Canadian real estate market. It's because the issue for housing slowing demand has nothing to do with people's ability to make monthly payments. Rather, the prices are driven up because there's no supply. However, to be fair, more and more listings are coming to the market right now, and in some parts of Canada, prices have started to drop. Now, the question is this in direct result with the new stress test? Well, I doubt that, but we'll have to see. So, therefore, people living in the big metropolitan areas such as Toronto, such as Vancouver and surroundings are going to be the ones affected the most, along with first-time home buyers. Why do I say that? Well, if you live in this big kind of cities, single-family homes average anywhere from $800,000 to $1.2 million. So, a home buyer's purchasing power in these areas is going to be reduced by $40,000 to $60,000, an average of 5% less than what you guys were able to qualify before. So to counter this lower purchasing power, they will have to show an increased income based on the ratio of assets to liabilities. In contrast, people least affected by this situation is individuals living in Canadian cities such as Winnipeg, Regina, Saskatoon, where the average single-family home is anywhere from $300,000 to $350,000. So, therefore, reducing their buying power by $5,000 to $15,000 as an average. And the same argument applies to counter this lower purchasing power. These individuals will have to show an increase in income anywhere from $1,000 to $2,000. All right, to wrap it up, this initiative of increasing the qualifying rate from 4.79% to 5.25% was introduced to lower bankruptcies and mortgage default payments and make the Canadian economy more resilient. However, do I think that by introducing this new qualifying rate, the demand for real estate is going to lower? I personally do not think that, as it is more of a supply issue rather than a financial issue. Well, that was it for today's video. Hopefully you guys did enjoy today's video, and if you guys did, make sure to smash that like button and subscribe down below, as that really helps me out a lot to reach out to more and more people like yourself. And until the next time, see you guys on the tripod.